In early February 2025, the trade relationship between the United States and Canada faced an unprecedented challenge. Escalating trade tensions stemmed from President Donald Trump's controversial decision to impose hefty tariffs on Canadian goods, citing concerns over illegal immigration and the growing problem of fentanyl trafficking. Trump's announcement on February 4, 2025, which included a 25% tariff on all Canadian imports, was a direct response to what he described as Canada's failure to address issues at the border, particularly related to the influx of fentanyl into the United States. The tariffs were designed not only to address these border concerns but also to shift the dynamics of trade in North America. A 10% tariff was specifically applied to Canadian energy exports, signaling a direct hit to Canada's crucial oil and gas industry, which plays a significant role in its economy. In response to these tariffs, Canadian Prime Minister Justin Trudeau swiftly announced retaliatory measures. Canada would impose a 25% duty on $30 billion worth of U.S. goods, set to begin on the same day as Trump's tariffs took effect. Trudeau further signaled that this retaliation could extend to an additional $125 billion in U.S. imports, pending a 21-day consultation period. The goods targeted by Canada included a broad array of American products, such as beer, wine, bourbon, fruits, fruit juices, clothing, sports equipment, and household appliances. However, after a series of intense discussions between the two leaders, a temporary reprieve was granted. Both governments agreed to delay the implementation of these tariffs for 30 days. Canada, in turn, committed to bolstering its border security measures. This included the appointment of a new fentanyl czar to oversee efforts to curb the illegal flow of drugs into the U.S., as well as collaboration on a joint strike force to combat the trafficking of illicit substances. Although this compromise averted immediate economic fallout, mixed reactions from within Canada persisted. The economic ramifications of the tariff war. Despite the temporary delay in the tariffs, the situation remained fraught with uncertainty. Economists warned of the potential long-term consequences of these trade measures, particularly in light of the significant interdependence between the two nations. The U.S. and Canada share one of the world's most integrated trade relationships, with trade flows of goods and services worth hundreds of billions of dollars each year. Any disruption to this relationship could have ripple effects across industries, leading to higher consumer prices, disrupted supply chains, and reduced market stability. One of the most heavily affected sectors would be the Canadian oil industry. Canada is the fourth largest oil producer in the world, with approximately 5.76 million barrels of oil produced daily as of 2023. Historically, the U.S. has been the largest market for Canadian oil, receiving the lion's share of exports. However, with the trade tensions mounting, Canadian oil producers were faced with the prospect of losing their largest customer. Consequently, they turned their attention towards other international markets, particularly those in Asia. The Trans Mountain Pipeline, one of Canada's key infrastructure projects, has become central to this shift. The pipeline, which transports oil from Alberta to the Pacific coast, has expanded its capacity to 890,000 barrels per day, nearly tripling its previous flow. This expansion, completed in May 2024, offers Canada a more direct route to Asian markets, and oil producers are now looking to capitalize on this opportunity as they anticipate increased demand from countries like China. The pipeline's expanded capacity has already begun to see an uptick in shipments to Asian refiners, with countries like China, Japan, and South Korea increasing their imports of Canadian crude. In particular, Chinese refiner Rengang Petrochemical secured multiple cargoes of Canadian crude in late 2024, reflecting the growing demand for heavy crude oil in China. This market shift is part of a broader strategy by Canada to reduce its reliance on the U.S. and to diversify its oil export portfolio in the face of volatile trade relations with its southern neighbor. Canada's oil production has witnessed impressive growth over the past few decades, particularly due to its vast oil sands reserves located in Alberta. As of 2023, Canada is the fourth largest oil producer globally, just behind Russia, Saudi Arabia, and the United States. The country's oil sands, primarily found in Alberta, are the third largest proven oil reserves in the world, estimated to contain around 180 billion barrels of oil. This vast reserve has become the backbone of Canada's oil industry. In 2019, Canada produced an average of 4.7 million barrels per day, with about 64% of that coming from unconventional oil sands production. By 2023, that figure had risen to 5.76 million barrels per day, further solidifying Canada's role as a key player in global energy markets. While Canada's oil industry has contributed significantly to the economy, it has also raised environmental concerns. Critics argue that the country's continued investment in oil extraction projects, such as the Trans Mountain Pipeline expansion, undermines its commitment to climate action. Canada has set ambitious targets for emissions reduction and has implemented policies such as a nationwide carbon tax. However, the contradiction between its environmental goals and ongoing investments in fossil fuel infrastructure remains a point of contention. The debate continues as to whether Canada can reconcile its economic growth with its climate action objectives, particularly when it comes to the oil sands industry. While tensions with the United States dominate the headlines, Canada has been quietly strengthening its trade relationships with other global players, most notably China. China has become Canada's second-largest trading partner, behind the United States, with bilateral trade reaching $25.4 billion in 2022. This growing relationship reflects a broadening of Canada's export markets, particularly in the wake of trade uncertainty with the U.S. In 2023, Canada exported a variety of goods to China, with oilseeds and oleaginous fruits, including canola, leading the charge. Canola exports to China saw a remarkable surge, increasing by 75.2% compared to the previous year. This surge was partly driven by China's recovery from COVID-19 and a growing demand for agricultural products. Other notable exports to China included iron ore, copper, coal, and wood pulp. These commodities are crucial to China's industrial growth and reflect Canada's role as a key supplier of raw materials to the Asian giant. Despite the growing trade relationship, Canada's trade balance with China remains negative. In 2023, imports from China totaled $100 billion, a 16% increase from the previous year. The trade deficit with China has raised concerns about the sustainability of the relationship, but Canada continues to diversify its export markets as a way to mitigate risks and reduce its dependence on any single trading partner. This extended analysis would cover further key points, such as the broader implications of trade tensions, the social and political ramifications within Canada, and a deeper look into the ongoing geopolitical dynamics between the US, Canada, and China. One of the most immediate concerns for Canada following the announcement of the US tariffs is the potential economic impact on Canadian consumers. With the imposition of a 25% tariff on a broad range of US goods, economists are warning that the average Canadian consumer could face higher prices on everyday items, from clothing to household appliances, as a result of these trade disruptions. The tariff on Canadian energy exports, though less significant in percentage terms, could also lead to an increase in fuel prices, further squeezing the budgets of Canadian households. Industries that rely heavily on U.S. imports, particularly the automotive sector, could also be severely affected. Canada's automotive industry, especially in Ontario and Quebec, is closely tied to U.S. manufacturers. These tariffs could lead to delays, increased production costs, and potentially even layoffs as supply chains become more disrupted. The U.S. is Canada's primary destination for automotive exports, and any disruptions in this sector could have long-term effects on Canada's manufacturing capabilities. Prime Minister Justin Trudeau, who has long positioned himself as a leader committed to multilateralism and a strong relationship with the U.S., has faced significant political pressure. His approval ratings were affected by the announcement of tariffs and the broader geopolitical uncertainty. His decision to enter into negotiations with the U.S. to delay the implementation of tariffs was seen by some as a pragmatic step to avoid immediate economic turmoil. However, it was met with criticism from those within Canada who believe the country should stand firm in the face of U.S. pressure. At the same time, there is a growing sentiment in parts of Canada that the country may need to reevaluate its trade dependence on the U.S. As tensions mount, some political leaders have suggested the possibility of greater economic ties with other global powers, particularly China. These discussions raise questions about the future of Canada's foreign policy, with some advocates calling for a more diversified trade portfolio that reduces the risks associated with U.S.-centric economic dependency. The broader geopolitical landscape is also shifting as Canada navigates its relationship with the U.S. amidst the growing influence of China. Canada's growing trade relationship with China, which has steadily increased over the past few years, has been a double-edged sword. On the one hand, it offers Canada an opportunity to diversify its trade relationships and reduce its dependence on the U.S. On the other hand, it also exposes Canada to the geopolitical tensions between China and the U.S., which have become more pronounced in recent years. The prospect of Canada strengthening its ties with China has raised alarm bells in Washington. The U.S. has long been wary of China's increasing global influence and sees China's growing economic ties with Canada as a potential threat to its own geopolitical standing. The Trump administration's remarks about Canada potentially becoming the 51st state of the U.S. could be interpreted as an attempt to exert pressure on Canada to realign itself with U.S. strategic interests, particularly in light of the growing U.S.-China rivalry. China, for its part, is keen to maintain and expand its trade relationship with Canada. In addition to purchasing Canadian oil and agricultural products, China has also invested heavily in Canadian real estate, mining, and technology sectors. These investments have strengthened the economic interdependence between the two countries, but they also come with their own set of challenges. China's rising economic power and global influence could place Canada in a precarious position as it tries to balance its economic interests between the US and China. Looking ahead, Canada's long-term strategy may involve further diversification of its trade relationships, reducing its reliance on both the US and China. The recent shifts in global energy markets, with rising demand for oil and gas in Asia, present an opportunity for Canada to expand its market access beyond North America. The Trans Mountain Pipeline expansion, which was completed in May 2024, serves as a key pillar of this strategy, providing a direct route for Canadian oil to reach Asian markets, particularly China. However, this diversification comes with its own set of challenges. Canada's commitment to combating climate change and reducing greenhouse gas emissions complicates its efforts to expand its fossil fuel exports. The country has set ambitious goals to reduce its carbon footprint, including implementing a nationwide carbon tax. Yet, the expansion of the Trans Mountain Pipeline and the increase in oil exports to Asia underscore the contradictions at play in Canada's approach to climate policy. Environmentalists have criticized the Canadian government for prioritizing oil exports over climate action, arguing that the continued expansion of oil extraction projects contradicts Canada's long-term environmental goals. The debate over the Trans Mountain Pipeline exemplifies the tension between economic growth and environmental sustainability. This challenge will continue to shape Canadian politics and policy as the country seeks to balance its economic interests with its environmental commitments. The road ahead, negotiations and uncertainty. As of February 2025, the US-Canada trade dispute remains unresolved. Both countries are engaged in ongoing negotiations to reach a more permanent resolution before the new tariff deadline. The Trump administration has made it clear that it is prepared to take aggressive action if Canada does not meet its demands on border security and drug trafficking. At the same time, Canadian officials are working to mitigate the economic impact of the tariffs and avoid further escalation. The delay in the implementation of the tariffs provides some breathing room, but the underlying issues of fentanyl trafficking, border security, and trade imbalances remain unresolved. For Canada, the path forward will require careful diplomatic navigation, as it seeks to maintain its strong economic ties with the US, while expanding its relationships with other global powers, particularly China. Canada must also address its internal divisions and the growing political opposition to its current trade policies. The outcome of these negotiations will have profound implications not only for the US-Canada relationship, but also for Canada's role in the global economy.